Well, the consumer inflation is the big story of the week. In the US, for October, it has come in at a red hot 6.2%, jolted all markets. Of course, equities and bonds recovered after a one-day fall, but the dollar index has climbed over 95, and the Fed fund futures are still indicating about 2.5 rate hikes next year. Morgan Stanley wrote a note explaining that items like used cars in the US may continue to push inflation up in November and spill over to December as well. Also, items like higher rents, which was one of the reasons why the October inflation went up, are likely to persist. They don't die away that easily. So the current inflation may not be all that transitory, is what several economists fear. Today we have with us Morgan Stanley's Asia economist, Chetan Ahya, to decode the impact of likely higher US and global inflation on global rates, on Asia and on India. Chetan Ahya, thank you very much indeed for joining me, and actually many congratulations. Wasn't it a year or 18 months back that you said that inflation is going to be the big problem of the 20s of this decade, and that's how it's turned out to be. But first up, are you revising your inflation forecasts for India and other countries in Asia because we may all have to contend with higher than expected US and global inflation?
First of all, Latha, thank you for having me. Look, on inflation impact in Asia, we are seeing upward pressure on inflation on headline because of higher oil prices. But in general, what we are seeing is that core inflation in the region has been well behaved, because across the region, we still have output gaps. And as such, COVID-related restrictions in countries like China and other places has meant that consumption growth specifically has not been that strong. And so we don't have that much of demand side inflation pressure as yet in Asia. But going forward in 2022, as we see output gaps closing, we do expect core inflation to pick up. But it still will be more or less in line with central bank's comfort zone, and we don't see big inflation pressures in Asia.
Okay. Well, actually, the FAO, the Food and Agricultural Organization, also is reporting that its food index is the highest in 10 years or something like that. There are other inflation, and of course, energy is one inflationary pressure. You are not changing the India inflation trajectory. No numbers are being changed for the moment?
No numbers are being changed for the moment, Latha. And look, when you look for oil prices and some of these commodity prices, and when you try to make the forecast, and what we do is we take futures prices. And if you see the year-on-year trajectory, a lot of these commodity prices, year-on-year numbers will come down next year. And so that's the reason why we are not yet thinking about changing our forecast for inflation. And at the same time, as I mentioned to you, the output gaps are still pretty wide. So in the developed world is different, particularly the US is very different, where you have very big fiscal stimulus that has actually brought that growth recovery to be much more stronger. And their economies have reopened, and you have consumption recovery, which is also pretty strong. So US is just a very different story right now compared to Asia.
Okay, so more of a US inflation or a developed economy inflation, perhaps not coming so much to Asia. Take that point, but financial markets are still pricing in interest rate hikes in the US, and that is the currency of the world. But the Fed fund futures are factoring in 2.5 rate hikes in FY22. What will that do to money itself? Do you see it moving away from Asia and countries like India? Do you see it rushing back to developed economies?
Well, I think this time it's different. I have to be careful before I say that. But I do think that this time when the Fed is going on the other path, tightening monetary policy, Asia is in a very different position. First of all, the most important variable that you would want to look at is interest rate differentials, whether you take 10-year real rate differentials or short-term policy rate real rate differentials. Those are very, very high right now. A part of the reason is that the US inflation is much higher than what we are seeing in Asia, which is usually not the case. But this time it is the case that inflation is low and real rate differentials are very, very high. So that gives one level of protection to Asia. The second is that the Asian current account balances are also in a very different shape. Even a country like India, which typically runs current account deficit, we know has been running very low current account deficit now. But if you take 4-quarter trailing, it's actually a small surplus. So I think both those macro parameters are very different. At the same time, we are expecting growth in the region to be strong in next calendar year, and that's what is also going to make investors attracted to the region. So we're not as yet as much concerned about financial inflows, capital inflows into the region.
Okay, now I'm just coming back to the inflows argument in a minute, but the dollar index over 95, is it not saying a different story? Shouldn't we worry?
So what you can see in currency markets is a very, as I mentioned to you, as Asian fundamentals are different. There's a ticker on Bloomberg which is called ADXY, which will tell you how our Asian currency is doing. So we have a divergence now. In the past, you would see that, as dollar would appreciate against euro and yen, Asian currencies would also depreciate against the dollar. But this time that's not happening, especially in the last 2-3 months. There is a clear divergence between paths for euro and Asian currencies. And you can see that in the rupee as well. It's been in a range-bound trend. So I think that risk is already being seen by the financial markets like currencies. Either Asia is in a much better shape.
Oh, fair point. Okay, we were just worried about this technical level of 95 being crossed. But you see, your point is that Asia may be divergent, or at least the performance of currencies. See, you're right in saying that we have a near current account surplus if you take the last 4-quarter average, as well excellent forex reserves, and therefore even any temporary movement of money away from India won't be a threat. But India is also riding a very high fiscal deficit at this point in time. Compared to the taper tantrum period of 2013, that is the only variable which is against India. Could that be a moment of reckoning? We are not going to get down that debt to GDP, government debt to GDP, anytime soon.
So Latha, that's a very important point. I have been also saying, you had me a few days back on our India focus note. And I had mentioned that fiscal balance is high and it needs to come down. And that is a risk as far as India is concerned this time. But we are optimistic that the fiscal consolidation path will be maintained as tax revenues go up and private consumption recovers. Policymakers will be continuing to focus on reducing fiscal deficit going forward lower. And as far as the inflation impact of fiscal deficit is concerned, look, I think, yeah, your point is valid that in 2013 we had even lower fiscal deficit than what we have right now. But there's one big difference on the inflation dynamic in India now versus 2013, and that is the impact of National Rural Employment Guarantee Act, which had lifted rural wages and that had taken food inflation and overall inflation closer to 10% for about 4 years. We don't have that now. If you look at rural wage growth right now, even urban wage growth, which we can sort of back out from the corporate data, is well behaved. And so I think that is one important element that will give comfort to the central bank that inflation is not going to be running away and be out of their hand. Okay. But your question is valid. Fiscal deficit is a risk, but at this point of time, to the extent to which we think that fiscal deficit will be taken lower, we think that's a manageable risk.
Okay. But what does that do to growth in that case? If fiscal deficit is, has to be constrained because of global financial factors, partly at least, then will not that impact growth? What are your growth numbers for India, and do you see that in any way getting impacted because of financial sector matters?
Not really. I mean, if you really have a disruptive moment in the Fed policy path or markets' expectation of a very disruptive move to be taken up by the Fed, and that is a risk too, but to the extent to which in our base case we don't expect that, we think that the financial market volatility will not be big enough to break the India growth story. The India growth story, as I had highlighted on this channel of yours before, is very different this time as well compared to what we had seen in the last 10 years. So this is a dynamic that we are seeing in India, which was last seen in 2003 to 7 cycle, where macro stability indicators are fine. We have structural reforms being taken up by the government, and you have external dynamic, especially exports on goods and services, which are also pretty robust, something that we had not seen in the last 10 years. So we are quite constructive on India's growth outlook, and we think that for the next 3 years, India will deliver an average growth of about 7%, which would be sort of effectively, highest amongst all major countries in the world.
Okay, actually, that's a great point to end the conversation. But I just like Oliver Twist will have to ask you one more. If the Fed fund futures, irrespective of what is Morgan Stanley's expectation, if the Fed fund futures are indicating 2.5 rate hikes by the Fed next year, FY22, how many rate hikes are you expecting from RBI itself? And therefore, where will interest rates be? At the moment at 6.35, the 10-year, between 6.35 and 6.4, where can it go next year?
So for RBI, we're expecting them to make the first move in the December meeting with a reverse repo rate hike. And as far as the repo rate is concerned, we're expecting 150 basis points hike in 2022. So we are a bit more aggressive on what RBI needs to do and what we think RBI will do in 2022 compared to some of the competition brokers. But we think that should be fine. The economy will be able to take it because right now we are running extremely low levels of real interest rates. In fact, it's negative 200 basis points. And you can take that cost of capital rise and it will still continue to support that recovery that we are forecasting.
That's a fair point. So an abundance of riches, a 7% secular rate of growth for the next 5 years from India. Thank you very much, Chetan Ahya, for joining us with your analysis. The red-hot US inflation not really going to endanger India much. The financial markets, even if they see a bit of a ruffle, won't be too serious. We're going to take a quick break and thereafter we have another important economist joining us, Rob Subbaraman of Nomura, on the impact of the US inflation and possible Fed rate hikes on India. Welcome back to Indianomics. Like we've been discussing, the US inflation in October hit a three-decade high of 6.2%. And it's not just that it hit 6.2%, it is widespread increase in prices of practically everything from groceries to cars to rents to medical services, items which may be persistent in their shortages, which has worried economists. We did speak to Morgan Stanley earlier. Nomura has also put out a report worrying that the medium-term inflation trajectory may also have to be increased. We have with us Rob Subbaraman, who's the head of macro research for Nomura. And let's ask him how Asia may fare under probably worsened macros. Thank you very much for joining us, Rob. Well, first, my question to you is, because of the change in the US inflation trajectory and your US analysts saying that they expect that even the medium-term FY22 inflation will be higher than previously forecast, does it change all the Asian and even Indian forecasts?
Hi, Latha. It's good to be back. I'd say the short answer is yes. We do think US inflation is heading higher. As you said, it's a bit over 6%. We think by around February next year, headline CPI inflation will probably be over 7%. And as you said, it is very broad-based. And we are starting to see, I think, some inflationary pressures developing in Asia, in India. We'll get numbers later tonight, but also in the Philippines, in China with PPI inflation. It's starting to go up. So these are supply bottlenecks that we're seeing, and also commodity prices, which are going up a lot, are global. It's a global issue. And so Asia will be part of it. And I think for Asia, Latha, the bigger area where we get the inflation is actually commodities. And the area that I'm very focused on, and I think could be the big risk for Asian inflation, is food prices.
Oh.
Food prices often follow energy prices. Energy prices go up first, and then because you use energy is the input for fertilizer costs through gas. It's used for, for all the machinery for agriculture. It's actually used for biofuels. When energy prices go up, land is substituted for biofuels instead of making food. So all this puts upward pressure on food. And food has a very, very big weight in CPI baskets in India, Philippines, Indonesia, these countries. So I think that is a risk that we face. The other one is the Fed could start raising rates, and that generally is negative for EM, including Asia as well.
Okay. Well, I'll come to that one by one. First, the inflation picture itself. Let me just play the devil's advocate. The output gap appears to have narrowed or even closed in developed economies, in the US maybe. There are a lot of people who argue in India it's perhaps south of 70%. When the RBI last put out the number, it was mid-60s. So should we follow suit?
So you're right. The recoveries in EM from the pandemic have been a lot slower than in DM, and you still have some capacity. But what we are thinking is and it's not for all EM, but if you look at Latin America or Eastern Europe, inflation is already quite high, and they have big output gaps, negative output gaps. The reason is the commodity price shock and the supply disruptions are so big that you're still getting excess demand. So you're right, demand is weak, but supply is, even weaker. And that's why you're getting the overheating pressures. And I think it is going to show up more in India in the coming months.
Okay. Well, that will be a worry because we have a proclivity for inflation more than perhaps other economies. And it's with great difficulty that over the past 5 years with inflation targeting, we appear to have, made it into the mid single-digit number. But Rob, what should we worry about? There are a lot of defenses that the Reserve Bank has already built. Excellent FX reserves for some 18, 20 months of imports. As well, current account surplus at this point in time, if you take the average of the last 4 quarters. So should we worry?
So I think we need to be cautious, right, still. As you said, the recovery is still nowhere near a full recovery in India. And we have in India, I would say, characterize it as weak fiscal finances. They're weak in most countries because of COVID. Governments did the right thing. But now, India was starting from a weaker position than many, and it has quite high public debt now. The risk to me and the thing to worry about is fiscal dominance. I think it's very important, if we are right at Nomura and inflation picks up in India, that the central bank uses its monetary policy independence and does try to get inflation back in target. Already, core inflation is very close to the top of its target, right?
Yes, it is.
So, and we think it could go higher going forward. So it's very important that the RBI, utilizes its independence and doesn't fall into the trap of supporting the fiscal deficit with low rates and just focusing on growth. Because the truth is, inflation expectations in India are already very high, double digit. As you said, India has a history of high inflation. Once the genie gets out of the bottle, the inflation genie gets out of the bottle, it's very hard to put it back in. I think India has made some great strides in getting away from double-digit inflation. It doesn't want to go back there. So to me, that is the key thing. The central bank avoiding fiscal dominance and sticking to monetary policy independence and making sure it tackles inflation.
Yeah, it's indeed very tempting to inflate your way when you have, 90% debt public debt at 90% or 95% of GDP. So that temptation is there. But, you know, the tax collections are also growing. And we are still not at full recovery, and tax collections are way above budget estimates. So is it possible that fiscal deficit will not be that big a problem if tax collections pick up at the pace at which they are? And a related question, therefore, how many rate hikes are you expecting from the Reserve Bank?
So you're right. I think the tax collections have been picking up. But don't forget, you know, once you have, there is a sudden burst of activity as you reopen the economy. And that's been happening in India in the last recent months. If I look at what's happened to the US and Europe as they've had reopenings, you do get a sudden burst and then it starts to ease off. There's pent-up demand initially. And so it's not clear that the tax revenues will continue growing as fast as they have. And Latha, you have to also be cautious. We talked about commodities. If energy prices, food prices keep going up, there will be pressure on the government to provide more subsidies to help the low-income households, yes. And that will weigh on the fiscal as well. Okay. So I think it's better to be conservative and cautious, and really I think as the economies recover, and India is recovering, it's getting out of COVID. Yeah. It's important that policies start to normalize. Okay. We don't want public debt going to over 100% of GDP. Yeah. We don't want inflation going back above 10%. No,
you actually, you're calling out the right stuff, because corporate tax collections are already peaking off, although individual tax, income tax collections are still climbing. So, you know, you're pointing out to the right red flags. Let me ask you a final question. Wear your macro global hat and tell us, you know, what are you expecting by way of Fed rate hikes, and where will the disruptions be? In 2013, we had the fragile five. Now, where will the disruptions come?
So we at this stage, we are forecasting the Fed to continue tapering all the way to June, so roughly a 7 months taper, and then the first rate hike in December 2022. Now, I would say, Latha, you know, with what's happening to inflation in the US, the risk is that the rate hike happens earlier. And at the market, some people are forecasting it as soon as June. It is possible, it's conceivable that the US Fed ends its tapering earlier, does it faster, and you could even have a rate hike a bit earlier than that. I think that's the risk, that it's a bit earlier. That instead of one hike in 2022, you could have two. So that's the risk around our forecast. For, you know, the effects of this, the interesting thing is a lot of this is priced in. The market is already pricing in at least 2 rate hikes next year, starting to price in maybe even more than that. So from where the Fed is now and where the markets are, there's still quite a gap. So in a way, you know, maybe it's not going to be so disruptive to emerging markets like the taper tantrum of 2013. But if you ask me where it would be if it is, I think it's more Latin America, economies there, which I think have among the weakest fundamentals in EM. So Brazil, Colombia, Chile, Peru, they really had a very bad COVID, and they have much weaker fiscal and current account positions than other EMs. Just to conclude, you know, on India, I did say we expect RBI to tighten. We do expect a 40 basis point reverse repo hike in December, and we are forecasting 3 repo hikes in 2022 in Q1, Q2, and Q3.
Okay. So we will have a 4.75 overnight rate. Well, at the moment, the market is in the mood to take that in its stride, but let's wait and see. Rob Subbaraman, pleasure speaking with you. Thank you very much indeed for joining me.
Thank you. Enjoyed it. Bye.
Bye. So as you can see, both the economists we spoke to confident that India will not be terribly hurt if there are rate hikes in the Fed, but the big Indian deficit is a problem. We wrap up on Indianomics on that note.
This is